$53 billion. That is the staggering amount that vanished from American bank stocks in a single trading session. I want you to sit with that number for a moment, because what I am about to tell you is not just another market story. This is a chain reaction that started with a trade policy, triggered the most aggressive financial retaliation in modern history from a G7 ally, and ended with the worst day for American banking stocks in over 3 years. If you own bank stocks, if you have a retirement account, if you hold any financial sector investment, you were affected by what happened today. And here is the part that makes this story different from every other market crash you have heard about. The world's most legendary investor lost an estimated $1.5 billion on his bank holdings today alone. And then he issued a statement that I have never heard the equivalent of in 50 years of following this man's public career. When an investor of that caliber loses that kind of money in a single day because of a trade policy, and then tells you exactly whose fault it is, you need to hear what he said. But before we get to his words, let me walk you through exactly how we got here, because the trigger itself took less than 30 seconds to read, but took about 7 hours to fully detonate on Wall Street. At 7 o'clock Eastern Time this morning, Canada's financial regulatory body, the Office of the Superintendent of Financial Institutions, issued an emergency directive that changed everything. The directive suspended the full service operating licenses of all United States headquartered banks with Canadian subsidiaries, effective immediately. 6 major banks were directly named in this action, the largest investment banks and commercial banks in America, institutions that collectively represent the backbone of Wall Street. The suspension means no new investment banking deals, no new wealth management clients, no new capital markets activity, no new merger and acquisition advisory mandates in Canada. Existing positions must be wound down over 180 days. After that, the doors close completely. In plain English, Canada just told the 6 most powerful banks on earth that they are no longer welcome to do business in the 9th largest economy in the world. The timing was deliberate. 7 in the morning Eastern gave the news exactly 2.5 hours to propagate through every trading terminal, every trading desk, every risk management system on Wall Street before the opening bell rang. By 8 o'clock, every portfolio manager with bank stock exposure had called their risk officer. By 8:30, the risk officers had called compliance. By 9 o'clock, compliance had called legal. And by 9:25, 5 minutes before the market opened, the sell orders were already stacked so deep that the opening was going to be a massacre. And everyone on every trading floor in Lower Manhattan knew it. The regulatory body cited reciprocal financial sovereignty measures, a direct response to Treasury restrictions on Canadian financial institutions, and the broader tariff escalation that has defined the past several months of this trade war. Canada's leader issued a statement that was 3 sentences long, measured and devastating in its calm. The statement said that Canada has always supported open financial markets, but open markets require mutual respect. And when that respect is absent, adjustments are made accordingly. The word adjust was doing all the work in that statement, framing the most aggressive financial retaliation a G7 nation has ever taken against another G7 nation's banking system as a simple, rational recalibration. Not anger, not revenge, just an adjustment. And that diplomatic restraint made it harder for Washington to respond with escalation because there was nothing inflammatory to react to. Just a policy, just a directive, just the end of Wall Street's access to $1 trillion financial market. Now, here's the insight that explains why the market crashed $53 billion instead of the $15 billion or so that the Canadian revenue loss alone would justify. American banks earn an estimated $14.8 billion annually from Canadian operations. That includes investment banking fees, wealth management for high net worth Canadian clients, and asset management for Canadian pension funds that collectively hold over $1.4 trillion in assets. To put that pension fund number in perspective, the largest Canadian pension fund alone manages over $500 billion. These are among the most sophisticated and most coveted institutional clients in global finance. And American banks have managed significant portions of their portfolios for decades. Add merger advisory on Canada's annual deal pipeline worth between $180 and $220 billion. Add capital markets trading. Add commodity trading in energy, minerals, and agriculture, and you get that 14.8 billion figure. That is revenue the size of a Fortune 500 company, gone in a single directive. The loss of $14.8 billion in annual revenue would normally produce a 1 to 1.5% decline in bank stocks. But the market did not drop 1% today. It dropped 3 to 4%. It dropped $53 billion. And I need to explain why that multiplier effect happened, because understanding this is the key to understanding why today matters so much more than just one bad trading session. The market did not just price in the loss of Canadian revenue. The market priced in something much bigger. It priced in the demonstration that a G7 ally, America's closest neighbor, its largest trading partner, a country that shares the world's longest undefended border, can lock American banks out of its financial system with a single regulatory directive. That is not a Canada problem. That is a structural problem. Because if Canada can do it, the European Union can do it, the United Kingdom can do it, Japan can do it, Australia can do it, and the market, in its cold and efficient way, priced in the probability that at least some of them will. The $53 billion was not about Canada. It was about what Canada proved is possible. And once the market understands that a risk exists, it prices that risk into every share, every bond, every derivative immediately and permanently. Let me walk you through the trading day itself, because the way $53 billion disappears in 7 hours is something most people have never seen up close. At 7 in the morning, when the directive hit the news wires, bank stock pre-market trading activated within minutes. The largest American bank, which had closed the day before at $222 per share, showed pre-market bids at $215. Another major investment bank, which had closed at $496, showed bids at $480. Stock futures dropped 0.5%. Financial news networks broke into regular programming with breaking news banners. The messaging platforms that connect every institutional investor on earth lit up with red headlines and urgent commentary. The futures market, the market that trades around the clock and reacts first to overnight developments, had already delivered its verdict before most Americans finished their morning coffee. Trading desk phones started ringing before the sun had fully risen over lower Manhattan. Portfolio managers calling risk officers calling compliance calling legal calling outside counsel to figure out what this directive actually meant for their Canadian operations. By 9 o'clock, 30 minutes before the opening bell, every trading desk on Wall Street knew what was coming. At 9:30, the opening bell rang, and what happened next was brutal. The opening cross, the mechanism that matches buy and sell orders when the market opens each day, was massively imbalanced. For every buyer of the largest bank stock, there were approximately 4 sellers. That bank opened at $213, a $9 gap down from its previous close. That single opening tick wiped approximately $16 billion in market cap. $16 billion gone in the time it takes to print one number on a screen. Other major banks gapped down between 2 and 4% at the open. The opening bell was not a bell today. It was a starting gun for a selling stampede. Between 9:30 and 10:30, the first wave hit, and it was not human. Quantitative trading algorithms, the computer programs that now account for over 60% of daily stock market volume, activated their sell protocols. These algorithms are programmed with specific triggers: sudden revenue estimate downgrades, geopolitical risk events, regulatory actions against the financial sector. This directive triggered all of them simultaneously. The algorithms do not panic. They do not hesitate. They do not call anyone to discuss whether this is the right move. They execute. And when hundreds of algorithms all execute sell orders on the same 6 stocks in the same 10-minute window, the selling pressure overwhelms the available buyers. The bid side of the order book evaporated. Market makers widened their spreads to protect themselves. The price fell, which triggered more algorithmic selling, which pushed the price lower, which triggered more selling. By 10:30, 1 hour after the open, the combined bank stock loss had already exceeded $30 billion, and the human selling had not even fully begun. The first $30 billion was not lost by panicking humans. It was lost by machines doing exactly what they were programmed to do. Between 10:30 and noon, the contagion started spreading. The bank stock crash began bleeding into the broader financial sector. Regional banks, none of them directly affected by the Canada block, fell between 1.5% and 2.5% on contagion fears. The market logic was simple and terrifying. If Canada can block the largest American banks, what stops other countries from blocking American banks? Insurance stocks fell on counterparty exposure to the affected institutions. The benchmark index that tracks banking stocks hit its worst intraday decline in over 3 years. Credit default swaps on bank debt widened significantly, meaning the cost of insuring against a bank default increased in real time. The volatility index, the fear gauge, spiked 18% in a single session. By noon, it was not just a bank stock problem anymore. The financial sector was bleeding into every sector with international exposure. Between 1 and 3 o'clock in the afternoon, the margin calls arrived. I want to explain what that means, because margin calls are one of the most dangerous mechanisms in financial markets. Investors who had bought bank stocks on margin using borrowed money received demands to either deposit additional cash immediately or sell positions to cover their shortfall. A margin call is forced selling. It is not a choice. When your positions lose enough value that your broker requires more collateral, you either wire money or the broker sells your stock for you. And forced selling does not negotiate. It does not wait for a better price. It hits whatever bid is available in the market. The margin calls push the selling into a feedback loop. Falling prices triggering margin calls, triggering more selling, triggering lower prices, triggering more margin calls. The largest bank broke below $210, its lowest level in 14 months. Stop loss orders clustered at that level. Automatic sell orders placed by investors who had decided in advance that 210 was their pain threshold, fired in sequence, adding more sell volume into a market that was already drowning in it. One of the major investment banks briefly touched the level 1 circuit breaker threshold, the point at which a stock has fallen nearly 10% from the previous close, and the exchange halts trading for 5 minutes to allow the market to stabilize. That bank recovered just enough to avoid the actual halt, but the near trigger sent a genuine chill through every trading floor on the street. A circuit breaker trigger on one of Wall Street's most prestigious institutions, that is not a headline traders expect on a Tuesday. In the final 30 minutes, bargain hunters stepped in. Short sellers who had profited from the decline began buying to lock in gains. Value investors who had been watching the carnage decided that bank stocks at 14-month lows might represent opportunity. The buying provided a modest bounce, enough to bring the losses back from their worst levels, but nowhere near enough to repair the damage. The final tally at the closing bell was devastating. The largest bank, down 4.2% with 24.4 billion in market cap, destroyed. The second largest, down 3.8% with 11.8 billion, gone. Another major institution, down 3.1% with $6 billion lost. The major investment banks, down between 2 and 4% each, losing billions more between them. Combined, 53.4 billion in bank market capitalization destroyed in one trading session. Each of these 6 banks has a different story behind today's carnage. The largest took the hardest hit because it had the most to lose. It is the largest American bank presence in Canada, earning approximately $3.9 billion annually from Canadian operations. It was the lead advisor on 3 active Canadian merger transactions worth over $10 billion each. All 3 are now in jeopardy. The bank's chief executive issued a terse, 1-paragraph statement calling the Canadian action unprecedented and deeply concerning. But that institution did not just lose Canadian revenue today. It lost the assumption that its global footprint was invulnerable to Allied retaliation. That assumption, it turns out, was worth more than the revenue itself. Another major bank lost nearly $12 billion, and the reason goes beyond its $2.1 billion Canadian revenue exposure. That bank is the largest holding of the world's most famous investor. His company holds approximately $33 billion in shares of that institution. It is his largest individual stock holding by value. When news broke that his biggest bank position was directly affected by the Canada block, institutional investors did not just sell on the fundamentals, they sold on the uncertainty. What will the legendary investor do? Will he add to the position? Will he start selling? The uncertainty about the most followed investor on earth added a risk premium that went well beyond the operational loss. One of the major investment banks lost over $5 billion and briefly touched its circuit breaker threshold, the single most alarming moment of the trading day. That institution's Canadian exposure is concentrated in the highest margin business in banking, merger advisory and investment banking. It was advising on the largest pending Canadian deal, a $14 billion energy sector consolidation, representing one of its biggest single advisory fees globally. The Canada block means it can no longer legally advise on that deal. Canadian banks are already circling to replace American institutions as lead advisors. And they are not just circling on that one deal. They are circling on every active mandate that American banks can no longer service. Bay Street is ready to absorb what Wall Street just lost. And the Canadian banks have the scale, the sophistication, and the client relationships to do it. Wall Street's loss is Bay Street's gain, and the transfer is already happening in real time. And that brings us to the man who lost $1.5 billion of his shareholders' money before lunch today. I have followed this investor's career for decades, and what happened tonight is genuinely unprecedented. He released a formal written statement about the market crash. That alone is significant. This man almost never comments on single-day market events. He is the most patient investor alive. He does not react to daily noise. He has spent 60 years telling people to ignore short-term market fluctuations and focus on long-term value. The fact that he issued a formal written statement about today's crash tells you everything about how seriously he takes what happened. His company holds approximately $33 billion in one major bank's stock, $3.5 billion in another, and several billion more in other financial sector positions. Today, his company lost an estimated $1.5 billion on those holdings alone. When this investor speaks about the $53 billion crash, He is not speaking from the sidelines. He is not offering academic commentary. He is speaking from inside the wreckage. His statement began with a defense of the market's reaction. He said, "The market is not wrong, that the market is doing what it always does, repricing risk based on new information." The new information, he explained, is that a G7 ally just demonstrated that American banks have a geopolitical vulnerability that nobody was pricing in. A single regulatory directive from a single allied nation can lock American banks out of a major economy. That risk premium, he said, will now be permanently embedded in American bank valuations. He continued by saying he has been investing in American banks for decades because he believed in two things: the strength of the American financial system and the reliability of the American regulatory environment. Today, he said, both of those beliefs took a $53 billion hit. That is this legendary investor telling you the market is not overreacting. The market is correct. The 53 billion is not panic. It is rational repricing of a risk that nobody had accounted for until this morning. Then he drew the causal chain explicitly and pointed the blame directly at the tariff policy. He said his company lost approximately $1.5 billion today on bank holdings alone, and he wanted shareholders to understand something clearly. That loss was not caused by a banking crisis. It was not caused by bad lending. It was not caused by excessive risk-taking by the banks themselves. It was caused by a trade policy. He said American banks are being punished by the market because the government provoked a G7 ally into retaliating against the American financial system. That is not market risk, he said. That is policy risk. And policy risk is the one kind of risk he cannot hedge. Then came the line that will echo through every trading floor tomorrow morning. He said, "There is an old saying in investing: when the tide goes out, you see who is swimming naked." Today's 53 billion, he said, proves that American bank stocks were priced as if the tide would never go out. Well, Canada just pulled the plug on the ocean. On the question of what comes next, this investor was direct. He said the question everyone on Wall Street is asking tonight is whether this is the bottom. And the answer, he said, depends on what Washington does next. If the tariff policy is reversed, markets will stabilize. If the tariff policy escalates, the next country to block American banks might not be Canada. It might be the European Union or the United Kingdom or Japan. And if that happens, he warned, the 53 billion lost today will look like a warm-up. He confirmed he is not selling his position in the major bank he holds, but he added a qualifier that rattled institutional investors. He said the thesis that justified his position, that American banks were the safest and most reliable financial institutions on earth, took damage today that cannot be repaired by one good earnings report. This, he said, is structural. A board member of his company described the mood inside their offices. The investor was calm, as he always is, but there was a sharpness to it. He reportedly said they just lost $1.5 billion because a tariff triggered a retaliation that nobody in Washington thought through. He said he would like someone in the White House to explain to his shareholders why that was a good trade. And then he paused and added that he suspects he will be waiting a long time for that explanation. When an investor of this stature tells his shareholders that the American banking thesis took structural damage, the foundational investment thesis that has underwritten the global financial system for 80 years, that statement echoes through every pension fund, every sovereign wealth fund, every family office on the planet. It is not a tweet. It is not an opinion. It is a $130 billion investor telling the world he is worried. And when this man is worried, everyone else should be terrified. Now, let me tell you what the 53 billion means beyond bank stocks, because the contagion from today's crash is already spreading in ways that will affect millions of Americans who have never bought a single share of bank stock in their lives. The broader market index closed down 1.4% today, losing approximately $560 billion in total market value. The financial sector's weight in the index dragged everything lower, but the contagion went beyond mechanics. Every sector with significant international exposure fell. Technology companies with Canadian operations dropped almost a full percent. Energy companies with Canadian partnerships fell 1.2%. Industrial companies with cross-border supply chains declined nearly a full point. The market read Canada's bank bloc as a signal that the trade war has entered the financial system. And when the trade war enters the financial system, the repricing does not stop at bank stocks. European bank stocks fell between 0.5% and a full percent in sympathy trading. Asian markets, which were open during the American afternoon session, showed losses as the news rippled across the Pacific. The $53 billion on Wall Street triggered an estimated $80 to $100 billion in additional global market losses before most of the world had gone to sleep. For the average American, the damage is personal and immediate. The market's 1.4% decline translates directly into retirement accounts. The average American retirement account balance is approximately $112,000. A 1.4% decline means the average American worker lost roughly $1,500 in retirement savings today. Not because of a recession, not because of a pandemic, not because of a financial crisis caused by reckless banking or speculative excess, because a tariff triggered a retaliation that crashed bank stocks and dragged the entire market down with them. Every American with a retirement account paid for today's trade policy, whether they voted for it or not. For Americans closer to retirement, those with balances of $300,000, $500,000 or more, the losses are proportionally larger and the time to recover is proportionally shorter. A 60-year-old with a $500,000 retirement account lost approximately $7,000 today, and they have maybe 5 to 7 years before they need that money. Financial advisors across the country spent the afternoon fielding panic calls from clients asking whether they should sell everything and move to cash. The most dangerous moment in a market crash is not the crash itself. It is the phone call from a retiree who has watched their savings drop and is ready to lock in the loss by selling at the bottom. In the credit markets, the institutional markets that most retail investors never see, but that professionals consider far more important than stock prices, the signals are even more concerning. Credit default swaps on major bank debt widened significantly, meaning the cost of insuring against a bank default increased in real time as the trading day progressed. Bank bond yields rose as prices fell, with investors demanding higher returns for the increased risk of holding bank debt in a world where allied nations can restrict bank operations by regulatory directive. The interbank lending rate ticked upward, a subtle but ominous signal that banks are slightly more cautious about lending to each other. That kind of micro hesitation in interbank lending is the same tremor that preceded larger credit events in previous financial crises. Major rating agencies both issued statements noting they are monitoring developments related to the Canada bank bloc. In rating agency language, monitoring is the word that comes before reviewing, which is the word that comes before downgrading. A credit downgrade for any of the big six banks would be catastrophic. It would increase their borrowing costs by billions, reduce the collateral value of their bonds, and trigger contractual provisions in thousands of derivative agreements that reference the bank's credit rating. The rating agencies have not acted yet, but they are watching. And when rating agencies watch, banks lose sleep.